everybody, this is Jamieson again. For those of you who don't know me, I'm the author of The Perpetual Wealth System and my new book, Wealth Without Stocks and Mutual Funds, both #1 bestsellers. I want to thank you for joining us on this video today. Today we're going to talk about two things. The main thing we're going to talk about is how never lose money in the stock market again. Did you know that it's not preordained that you have to sustain losses in the stock market? That's not taught in the traditional financial world, but it absolutely is not mandated that you lose money to Wall Street. So first of all, let's talk about the stock market ups and downs. First thing I want to tell you is I can guarantee two things about the stock market. Stocks are going to go down heavy and they're going to come back strong. Or they're going to go up heavy and come back weak and tank again. In other words, guys, market's going to go up, it's going to go down. I can guarantee you that. What I can't guarantee you, nor can anybody else, contrary to what they say, is I can't guarantee you when and by how much those events are going to take place. So the old rule of thumb is, well, just keep your money in for the long haul, because if you take an average of the last 5 years or 10 years or 100 years, whatever average you want to take, stocks have done fantastic. Problem is, I stand here today, we've had 3 major stock market collapses just in the last 16 years. So I know this, another one's coming. And most of you watching this went through those last 3. Think about the last one, when you couldn't even open up your statements because you didn't want to see how bad your 401k or your IRA was doing. Folks, it doesn't need to be that way. After you watch this kind of information, then you're making a choice to let it be that way. So I want to talk about a very specific strategy that we use with clients from all over the country, and it's called indexing. Now, what's indexing? First of all, before you talk about indexing, you need to understand how 99% of you are playing the market right now. Most of you own mutual funds, and those mutual funds own all kinds of different stocks within the fund. You own a piece of the fund, and they own the stocks, which means indirectly you own all those stocks. So when you have huge downturns of 30, 40, 50, 60%, most of your money participates with that. And by the same token, when you have run-ups of 20, 30, 40, 50%, your money most of the time should participate in that as well. Now, there's some exceptions to every rule, but that's basically how it works. The only problem is you have to be prepared to take big losses. And one of the things that a traditional financial planner is going to ask you is, what kind of investor are you? Folks, that's code for how much money can you lose? How much money can you afford to lose? And of course, that's going to depend on how old you are. There's another video we have on this page, talked about the wealthy stages of life. If you want to do yourself a favor and watch that. But I want to give you a strategy that we use called indexing, where you can participate in most of the market ups, but none of the market downturns. Now folks, think about that. If this is true, and it is, that you could participate in most of the market upswings, and yet never participate when the market goes down, even when it goes down big, you don't lose a dime, why would you ever play the market any other way? Now, there are some people that like to trade stocks. They have very specific stock trading strategies, and we're not against that. What we are against is using your retirement account and all of your retirement account to do those kind of things. The vast majority of a retirement account, especially as you get closer to retirement age, should be in very safe yet productive vehicles, and that's what I'm going to share with you today. Let's talk about indexing. What is it? Let's say, for the sake of example, you put your money in a product that's going to assess your gain, or sometimes your loss if it's not the right product. It's going to assess that gain or loss based on what an index does. So as an example, let's just say it's January 2nd, right? And you put $100,000 into one of these vehicles, all right, one of these products. And for the sake of example, just because everyone understands or has heard of the S&P 500, there's all kinds of indexes you can track. But for this example, we're going to keep it simple, and we're going to say that your gain or loss is going to be based on putting in money on January 2nd, and we're also going to see what happens to that money over the next year. So when you put the money in this vehicle, you're going to track an index. In this example, we said it's the S&P 500. Now, the S&P 500 is trading much higher than this, but for the sake of simple math, we're going to keep everything with 100. So let's just say the index was down here, and it was trading at 100 when you put your money into this program. All right? Fast forward a year later, it's now January 2nd of the next year. And now you look at this index, and let's just say the index is up to 110. So it went from, the index that you're tracking went from 100 to 110. 10% gain. All right, let's say that your money got credited with 7% of that gain. You didn't get the entire 10%, but you got 7% of it. All right, it's not so bad. But why don't you get all of it? Well, let's go to the next year now. Okay, next year, market drops. And let's say that same index that you started tracking at 100, that at its peak in the next year was 110, and now it drops all the way down to 90. Now, if you own the actual mutual fund, then your money would go down accordingly. But because of the way these particular products are set up, your money, remember, let's say you got $7,000 credited to your account the first year, so you have $107,000. Next year the index got hit hard. Guess what, folks? Your $107,000 slides over and you don't lose a dime. So let me ask you this question. What would your finances look like of over the last 20 or 30 or 40 years, obviously depending on your age, if you'd never lost a dime in the stock market? If you didn't participate in losses but participated in most of the gains? Would you have more money? The answer is yes. Okay? So let's go to the next year though, because let's now, that index comes back up, over the next year, comes back up to 95. So remember, we started tracking at 100, its peak for us was 110, then its low was 90, and it now is up to 95. So guys, if this was an actual mutual fund, or an actual stock holding, would you be break even yet? No, you could very easily be 4 or 5 years into this thing and still be down. The next year could go down back to 90. And let's say that next year has a really big year from that 90, and it goes back up to 100. So if you would have owned the actual mutual fund or shares of stock that did that, you'd be break even. You're 5, 6 years into this plan, and your money's break even. You're back up to $100,000 minus all the fees you paid. Okay, guys. Well, when you practice indexing, that third year, remember, when the market went down, you didn't lose anything. When the market went up, you participated in most of that upswing. So if it went up, let's say 5 points, maybe you participated in 4 points of that. So maybe you got credited 4% of $107,000. For the sake of example, we're going to call it $5,000. Now you have 112. But the next year, but wait a minute, someone will point it out to me, wait a minute though, how could I get credited from here to here? I'm not even back up to the original yet. So how can I actually make money? Because if it's a share of mutual fund or a stock, you wouldn't make money. But see, indexing is different. If it's done right, and we do it right, you put it in a product that has what's called a reset. Write that down. In fact, I'm going to write it down. Reset. Which means the index will reset every year on your anniversary date. So the first anniversary date, remember, the index was on 110, we got credited profit. The next anniversary date, index went all the way down to 90. We didn't get credited any profit then, but we didn't lose any money either. The next year, now our new basis for that year is at 90. It's not at 100. So if it goes north of 90, we're going to make money. So now it went up to 95. We got credited some. Here's our next point, is here. It resets. So it resets on your anniversary date, whether it be up or down. But you never have one of these situations where a client I was on the phone with last week said, you know, John, he's a new client, and he's talking to me, he goes, you know, I'm really just break even. The best he can figure, he's break even for the last 7 to 8 years doing the old traditional financial stocks, bonds, and mutual funds. Think about that, 7 or 8 years and he's even. And right now, as I record this, it could be different when you watch it, but the market's up. So could the market take a big downturn? And he's down again. And he's waiting another 5, 8, 10 years to break even. Those are the realities of the kind of the market that we're in, and we have been in now for the last 20 years. So it's possible you could have money sitting there 10, 15 years and break even on it. because of this average rate of return. However, if you practice indexing and you only participate in the profits, don't participate in the losses, right? And you get a reset every year where your money, if it's down low and it rebounds off of that year, even if it might not be back up to the top or even where you bought in, but your account still gets credited with cash that year. Folks, that's a game changer. Once you understand this, I'm not sure why you would put most of your retirement funds at risk doing the traditional stocks, bonds, and mutual funds. So I try to keep these as short as I can. There's all kinds of other training videos on here. Again, my name is John Jamieson. I'm the best-selling author of The Perpetual Wealth System and my new book, Wealth Without Stocks or Mutual Funds. I'm going to suggest that you buy the book. I'm also going to suggest you call our office directly. Phone number should be on the video. And reach out to one of our representatives and let's see if we can help you. And in the meantime, rewatch this. It's called Indexing and Resetting. I want to thank you for tuning in. Talk to you soon.